Hi, Danielle. Thank you very much for joining us today. How are things in New York?
They're going swimmingly. It's almost as warm here as it is in Texas. So, there's something to be said for that. It's definitely the heat of summer. I suspect that half the island right now is headed to the Hamptons.
Yes, yeah, that's a good idea. So you live in Dallas, but you're in New York for Fed Day?
For Fed Day, it's like a Super Bowl every few weeks for me. So, it's always good to kind of be on the field, so to speak.
That's good. That's good. So we have a lot to discuss in a short period of time. And the first thing I want to discuss, of course, is the Fed announcement. And as predicted, interest rates are staying unchanged, and they've been that way since July of 2023. Can't believe it's been a year already. But what are your thoughts and any concerns out of the minutes or out of the comments from Jerome Powell?
It's not concern as much as it's an observation, I think, of hubris on the part of the Fed to have he actually let it slip at the podium that they had discussed lowering rates at the July meeting. So my observation would be, if that's even up for discussion right now, then why wouldn't you have gone ahead and pulled the trigger? The Fed's longest period, you just mentioned we've gone 12 months. The Fed's longest period in between moves was the 15 months that led up to the great financial crisis. So I think the lesson of that episode is that you can wait too long, and in doing so, commit a policy error.
So I want to ask you about that. And before I do that, though, according to the CME Fed Watch, the probability of a cut in September is now approaching 100%. Do you think we're going to get a cut in September? And if so, how large?
So I think we are going to get a cut in September. I think that is your absolute base case. We actually saw the 10-year yield, because the continuing jobless claims, the initial jobless claims, the ISM report were so much worse than what was expected, that we saw the 10-year yield, the benchmark yield, fall below 4% in trading. And of course, the irony is this is one day after the Fed announces that it's going to be standing pat. Powell was very adamant that 50 basis points in September was not on the table. Let's wait and see what markets begin to price in.
And so one of the things that comes to my mind is that the longer we hold off, the closer we get to the election. And I guess if he does do the first cut in September, can this not be construed as being political, like favoring the Democrats because it is so close to the election?
I suppose some could come to that conclusion, but of all of the Fed chairs since Paul Volcker, Jay Powell is the least political. He now that's not to say that he's not wise with his time. He has spent more time on Capitol Hill meeting with Congress members on both sides of the aisle than any of his predecessors. So he's very active in terms of listening to what politicians have to say about what's happening with their constituencies. But in terms of trying to lean one way or another because of one of the other presidential candidates, I believe him when he says that he is absolutely apolitical.
Yes, and a reporter did ask him that yesterday, and he was quite adamant, and he almost looked like he was getting pissed off.
Oh, yeah. No, he did. And again, we have to understand that neither president has actually been very friendly to Jay Powell. So he wouldn't have an allegiance to either of them. But more importantly, I think it speaks to his integrity that he not be swayed politically, because his three predecessors certainly were.
So I want to ask you about the recent GDP number that we saw for Q2. It came in at 2.8%, much stronger than what was expected. What's your take on this number? Do you think the economy is heating up again, or is this just an aberration?
We did see an unusually large inventory build for the second quarter, and that was a big contributor to GDP. In addition to that, the way GDP math works is if you have a surge in imports, that tends to bolster the number as well. But I think that there are a lot of one-time issues that you're seeing, one-time factors that you're seeing. You're still seeing gross domestic income run well below gross domestic product. So, I've been trying to explain to people that the National Retail Federation came out and made a very unusual announcement a few weeks ago, and that was that U.S. retailers, based on this notion that the U.S. consumer is strong, purchased holiday about 3 months earlier than they would in other years. And what does that mean? That means that we had this bulge in inventory in the second quarter GDP figures that we will not see repeated in the third quarter. And it also sets up retailers for a very messy back to school and holiday season, because I think we all know at this point that the U.S. consumer is not strong.
I want to ask you about inflation now. It's still above the Fed's target rate of 2%, but I've heard you say before that you actually think the actual real inflation number is below that. But let me play devil's advocate here. Do you think the Fed's making a policy error by cutting in September and risking that inflation does pick up again, especially with such a strong GDP number?
Um, no. And, when he was asked, when Chair Powell was asked pointedly, if you're still concerned about inflation, what specific areas concern you? Because we're now seeing home prices turn around. We're seeing rents begin to fall. Of course, that's the biggest contributor. We know that because of how the healthcare math works out in the CPI, that's going to start being not additive, but deductive in October. The tea leaves just do not suggest that inflation is going to come roaring back. You've had countless surveys. The conference board came out and said, consumers are not spending on services anymore. So that's not going to be a source of inflation. And in fact, the conference board, ADP's chief economist also said, if you're looking at wage inflation as a potential source of risk, Chair Powell, don't look at wages. They're coming down. Trueflation, which I follow very closely, it's got a 97% correlation with headline CPI in raw data back to 2012. It chimed in at 1.38%. We're seeing major disinflationary pressures.
So why is the trueflation number so much lower than the CPI number?
Runs ahead of it, and it's because the CPI always has lags in it because of the way it's constructed, whereas trueflation is a real-time inflation metric. You're actually seeing what prices are on the ground in the moment on an everyday basis.
And when you look at other central banks, Canada, for example, has already cut twice. Europe has cut. The Bank of England just cut. It appears that they're more worried about growth, or that the economy is slowing down too much than they are about inflation. What are your thoughts about these other banks, and why are these other banks cutting before the Fed does?
Well, I think that they are more concerned about growth. Canada was able to avoid a balance sheet recession, a reckoning in its residential market going into 2007, 2009, that great recession in the United States. And Canada's headed that way. So the Bank of Canada needs to be, I think, more aggressive than others because of the fact that we're starting to see that housing bubble finally implode. And that's going to make the job of monetary policymakers there that much more difficult. We also have to bear in mind that Germany just fell back into recession. The manufacturing figures coming out of Germany, out of the second largest economy, France, they're very contractionary. So the ECB is correct to be worried about growth, and you're seeing unemployment go up in Britain. So, and you're seeing the same things here in the United States. But again, the Fed is choosing to look at indicators that Chair Powell himself has said non-farm payrolls are overstated. So they know that the revisions are coming, but yet they're choosing to, if I can use a metaphor, drive through the rearview mirror.
So I want to throw a fun fact at you about Canada. We have the most number of construction cranes in all of North America. At last count, I think it was around 220. The second highest city would be LA with 50. So it gives you some idea of what's happening here with construction, and especially in the condo market. So I think we're due for a big pullback.
Yeah, and the problem with having that many cranes in the sky is that this is going to prolong the downturn because there's going to be so much excess supply. There's a similar dynamic that's playing out right now in the Miami market.
And so I want to ask you about a couple of other data points, both oil and copper, which are quite often seen as barometers of the global economy. Oil's been trading in between $70 to $80 a barrel. Copper has fallen down from $5 down close to $4 a pound. But what are your thoughts on this? Do you think both of these indicators are suggesting that the global economy is also slowing down?
Yeah, I think that that's a very real risk. You had China come out and it showed that its manufacturing PMI for small and medium sized businesses had fallen into contraction for the first time in 9 months. New orders in that particular report fell to the lowest level in 12 months. Even though we don't get actual hard, true GDP figures, it's clear that China's in recession. It's clear that therefore Germany's in recession. It is clear that even with the Olympics, that France is in recession. And then you've got other developed economies such as Canada as well. So the globality, if you will, of the current recession is very troublesome. And that's what copper is reflecting. It's not that India is not going to necessarily begin to offset the slowdown in the Chinese economy. It's that it's not going to manifest the way that it did in China. There's not going to be any massive, huge infrastructure build out that we saw in China. India is going to tend to go small with what they manufacture. So there's not going to be this tremendous demand for copper. And that's why they call it Dr. Copper. It's telling you that the global economy is in recession.
So I recently read about LVHM, and they also missed their numbers. A lot of it had to do with what's happening in China. And they also said their champagne sales were down 50% because people in China were not buying champagne. They had nothing to celebrate.
I think that there was a lot of anticipation and hope that when China did reopen, that there would be this kind of surge, a swell of spending. But when you lock that many people up for as long as the Chinese government did, well, the fallout is that they have ended up saving more than they would have otherwise because they're shell shocked from their experience with the pandemic, such that they want to make sure that their cushion is thicker than it would be otherwise. And there's also a large backlash against many Western economies right now with Chinese consumers pushing away from buying imported products, namely that of the United States. But of course, anything that represents a U.S. ally would certainly be in the crosshairs as well. And that's what we're hearing from not just from LVMH, from Richemont, from Hermes. We're hearing it across the luxury space.
And even Starbucks just came out with their Q3 numbers. It was their second consecutive quarter of missing top line, bottom line. And they also suggested there was a big pullback in China. I think they said same-store sales were down 14%. So not only are they not buying champagne, they're not even buying coffee.
Again, it's very difficult to quantify the macroeconomics of Chinese people saying, "How dare you take TikTok away?" Or even discuss it. So there's a lot of nationalism going on in economics right now. And at the same time, we know that demographically speaking, the Chinese economy is slowing of its own volition and that they've got a property collapse going on in that country when households were overly exposed to housing. So there's a lot of dynamics going on that are inside the country as well as influencing from outside of its borders.
So you touched on real estate, the real estate market in the U.S. earlier, and I just want to spend some more time on this. And new home sales were down in the month of June. I recently heard an interview with the CEO of Redfin, Glenn Kilman. He recently said the housing market is in a funk. He also went on to say that the two of the strongest markets previously were both Texas and Florida, and they're also experiencing sharp pullbacks right now. And then once again, just to touch on another data point out of this company called Wayfair, they look after, I guess, a lot of furniture. They also said, the CEO also said that the slowdown that they're experiencing right now in their stores or on their in their business is on par with what they experienced during 0809.
There was an overabundance of fiscal stimulus that was pumping its way through the U.S. economy. Americans pulled forward quite a bit of their purchases dedicated to their homes. They no longer need to replenish. They've remodeled. And we're also seeing job losses mount in the United States such that large purchases are just off the table. So, I grew up in San Antonio, Texas. There was a furniture manufacturer and vendor that had been around for 115 years that went out of business. And it had survived, the Great Depression and other economic calamities. It's unprecedented, I think, what we're seeing right now. And I think it's naive to assume that just because there's no subprime housing bubble in the United States, that there's not a lot of leverage attached to it and homeowners who are going to be in distress.
Interesting points. And I guess the other thing too that I think is quite interesting is what's happening within the commercial real estate market. And of course, this whole work from home thing is having a big impact all through North America. And Moody's recently came out and said that vacancy rates have hit 20.1% across the US, highest since 1979. And then when you look at certain places like San Francisco, we all know what's happening there, but their vacancy rate is 35%.
And even in healthy markets like Dallas, it's pushing 30%. Why is that? Because they ended up building a lot of new buildings, and now they've got more than what they need. And we've seen a lot of that. That's one of the upshots of being too low for too long with monetary policies, that you're going to encourage development and investment that does not make sense in a downturn. And that is what we're seeing with commercial real estate. It's interesting that you bring up the corollary to 1979, because when people ask me how I see commercial real estate, especially because so much of it is multifamily in this current cycle, meaning it's tied to the residential market, it does resonate with the old savings and loan scandal that we had.
So when we look at the equity markets, the S&P and the NASDAQ, lots of volatility here in the last couple of weeks. Like every day, the market's up 3, down 3. But you have said in the past that rate cuts will lead to market sell-offs. And do you see the market selling off as we go into year end and as the Fed becomes more aggressive with their rate cuts?
So historically speaking, in the post-war era, I think starting with 1953, I want to say, when the Fed does begin to cut rates, that is when markets actually correct. It's a signaling device, if you will. Gee, if they're cutting rates, maybe they do think that we're in a recession. So it's buy the rumor, sell the news type of mindset. And we have seen the level of unemployment in the United States, the number of individuals who are unemployed, cross some critical historical thresholds that have historically led to an average of 33% declines in the Standard & Poor's 500. And that's kind of where we're headed, especially, I just mentioned the savings and loan crisis of the 1980s, but when you look at the stock market and how it's behaved, it certainly is reminiscent of 1999, 2000.
Yeah, especially with the AI and the valuations that we've seen here in some of these names. It's just insanity.
It is, especially when you look at things, I think, through a more sober prism of price to sales as opposed to price to earnings. And that's what we're hearing a lot of companies mention this particular earnings season, is that they're missing their revenue line.
So Danielle, when you add up all these elements and you look at increasing unemployment rate, a decreasing inflation rate, we have all these commodities pulling back in price, oil, copper, we have a slowdown in numerous other countries throughout the world, including China, which is the second largest economy in the world. What does all this mean for the U.S.?
So I think that what we're seeing right now, as you very well describe, is a confluence of factors that suggest that the recession in the United States could be more prolonged and deeper in nature than what we would call kind of a plain vanilla recession. And a lot of that has to do with the fact that during the 2015, 2016 industrial recession, during the Great Recession, 2007, 2009, China had the capacity, China had the money to come out and buy commodities and kind of pull the rest of the world out of the downturn and staunch the bleed, if you will. That's not where China is right now. So I think we have to be very in tune to that element not being present this time around, and that investors especially need to be kind of in close contact with their risk appetite right now, and how they feel they should be hedging their portfolios accordingly for a longer recession than what most people are used to, looking back historically 10, 11 months.
Great insights, Danielle. You, as we wrap up, you are a very prolific writer. And if someone would like to see your research or follow you online, where can they go?
So we publish every trading day of the year at QI Research. Please come to dmartinobooth.substack.com. And if you don't follow me on Twitter already, I would certainly love to have you as a follower at DiMartino Booth as well.
I noticed you are approaching 300,000 followers.
Yes, I'm about to cross this Rubicon. So yes, it's been a long journey from being in isolation as a central banker working in the Fed, where we weren't even allowed to be on social media, to where I am in the years since I've left the Fed. It's a responsibility, and it's one that I relish.
So the next Fed meeting is going to be September the 18th. We will be well into the NFL season by then. So if we
Yes.
do get together, we can have a lot more to talk about besides the Fed.
Well, we can and we will, but you have to bear in mind, I grew up with the Houston Oilers and Warren Moon, who went on to greatness in Canada. But I'm a huge college football fan, so we can certainly talk about my Longhorns and their prospects when we meet again.
By all means, once again, thank you.
Thank you.